The idea of $1 million home once carried a powerful promise. It symbolized success, safety, and permanence. For decades, buyers believed that once you crossed into the seven-figure housing market, volatility faded and certainty took over. These were the homes that survived recessions, shrugged off downturns, and rebounded faster than everything else. But that belief is quietly collapsing. Across the United States, a growing number of million-dollar neighborhoods are experiencing a kind of pressure they were never designed to withstand. Price cuts are spreading, listings are stalling, and the confidence that once defined luxury real estate is beginning to fracture. This shift isn't about starter homes or entry-level buyers. It's happening at the very top of the market, where prices soared the fastest and assumptions went unquestioned the longest. In city after city, homes that once attracted bidding wars are now lingering. Sellers who expected instant offers are cutting prices again and again, and buyers, armed with higher interest rates and a more cautious mindset, are no longer rushing in just because a property carries a premium price tag. What we are watching unfold is not a single collapse, but a recalibration, one that exposes how fragile even the most expensive markets can become when conditions change. To understand why this is happening, you have to look beyond headlines. The luxury housing market is being squeezed from multiple directions at once. Mortgage rates above 7% have drastically altered affordability, even for high-income buyers. A monthly payment that once felt manageable suddenly becomes a psychological barrier when carrying costs jump by thousands of dollars. At the same time, property taxes, insurance premiums, and HOA fees have surged nationwide, turning ownership into an ongoing financial commitment rather than a static investment. Even buyers who can afford these homes are asking harder questions. Not just, can I buy, but does this still make sense? There is also a supply problem that many people overlooked during the boom years. From roughly 2019 through 2022, developers aggressively expanded luxury construction, convinced that demand would never slow. Upscale condos, oversized single-family estates, and speculative high-end developments flooded markets that were already expensive. When money was cheap and confidence was high, absorption rates masked the risk. But once demand cooled, that extra inventory didn't disappear. It piled up. And in real estate, excess inventory almost always leads to price pressure, no matter how prestigious the zip code. Another key factor is buyer psychology. Luxury buyers are not immune to fear. In fact, they are often more sensitive to market signals because the stakes are higher. When prices begin to slide, hesitation sets in. Buyers wait, expecting better deals later. Sellers resist at first, then compromise. That standoff creates stagnation, and stagnation is deadly for high-end markets built on momentum. Unlike entry-level homes, luxury properties do not benefit from endless demand. Their buyer pool is narrow, selective, and heavily influenced by macroeconomic confidence. It's also important to recognize that the definition of a good deal has changed. During the peak years, appreciation itself justified almost any purchase. Today, buyers are focused on downside risk. They look at resale potential, carrying costs, and long-term livability. Remote work has further complicated the equation. Many buyers no longer need to anchor themselves to legacy wealth centers, weakening the automatic appeal of once dominant cities. Luxury has become portable, and that mobility is quietly reshaping demand. This is not a repeat of 2008, but it is not insignificant either. Back then, the collapse spread from the bottom up. This time, pressure is showing at the top first. Million-dollar homes are falling not because they lack value, but because the assumptions behind their pricing have shifted. In many cases, prices moved faster than fundamentals, and now reality is catching up. That does not mean every expensive home is a bad investment. It means the margin for error is gone. In this countdown, we are breaking down 10 U.S. cities where million-dollar homes are falling the fastest, not to sensationalize the downturn, but to explain it. Each city reveals a different version of the same story, one shaped by supply, costs, migration patterns, and changing buyer behavior. By understanding where prices are slipping and why, you gain insight into what the broader housing market may face next. If you own property in one of these cities, this analysis matters. If you are considering buying, it matters even more. These shifts create risk for the unprepared, but opportunity for those who understand the landscape clearly. Million-dollar homes are not disappearing, but the era in which they were automatically protected from decline is ending. What replaces it is a more grounded, more selective market, and for anyone paying attention, the warning signs are already visible. The first city where the pressure is becoming impossible to ignore is Dallas, Texas. For years, Dallas was marketed as a bulletproof luxury market, a place where million-dollar homes felt almost affordable compared to coastal cities. Executives relocated, investors followed, and developers raced to keep up with demand. Upscale neighborhoods expanded rapidly, and new luxury builds appeared almost overnight. During the boom, buyers believed they were getting both value and safety, but that balance has shifted. Million-dollar listings in Dallas are now sitting longer, and price reductions that once seemed unthinkable are becoming routine. The problem is not desirability. The problem is oversupply colliding with rising ownership costs. As property taxes climbed and insurance costs surged due to extreme weather risks, carrying a luxury home in Dallas became far more expensive than most buyers anticipated. At the same time, higher interest rates erased the monthly affordability advantage that initially drew buyers from more expensive states. Investors who expected strong rental demand are discovering that high-end rents no longer cover expenses. When appreciation slows and cash flow disappears, even confident markets begin to crack. Dallas is learning that rapid growth, when unchecked, can quickly turn into vulnerability at the top. Moving east, Miami offers a very different version of the same lesson. Miami's luxury market thrived on global money. International buyers, remote workers, and lifestyle-driven investors poured billions into waterfront condos and modern high-rises. For a while, demand appeared limitless, but luxury markets fueled by outside capital are highly sensitive to global conditions. As interest rates rose and international uncertainty increased, that steady flow of buyers slowed dramatically. What remains is a city with thousands of new luxury units competing for a shrinking buyer pool. Insurance costs have become a breaking point in Miami. For waterfront homes, premiums that once felt manageable now rival mortgage payments. HOA fees in luxury towers continue to rise as buildings age and maintenance costs grow. For many owners, the math no longer works. Buyers are not rejecting Miami as a destination, they're rejecting the financial burden tied to ownership. That distinction matters because it means price adjustments are not temporary reactions, but necessary corrections. Scottsdale, Arizona reveals how lifestyle-driven luxury markets are also vulnerable. For years, Scottsdale represented an ideal blend of sun, space, and status. Retirees, second home buyers, and short-term rental investors flooded the market, driving prices rapidly higher. Developers responded aggressively, building upscale communities at a pace rarely seen in desert markets. But luxury demand in places like Scottsdale is highly discretionary. When borrowing costs rise and investment returns soften, buyers simply wait. They are not forced to act. Inventory builds quietly. Then suddenly, sellers find themselves competing against one another. Wildfire insurance, rising HOA fees, and declining vacation rental occupancy have all contributed to Scottsdale's slowdown. Homes that once sold in weeks now linger for months. Price cuts do not signal collapse, but they do reveal imbalance. Markets built on seasonal demand and secondary ownership lack the stability of primary residence cities. Scottsdale's luxury decline shows how quickly confidence can fade when external conditions change. Los Angeles represents a different challenge entirely. Here, million-dollar homes are not just luxury purchases, they are cultural symbols. But even symbolism cannot overcome economics. The combination of high taxes, extreme insurance costs, and shifting industry dynamics has reduced the pool of qualified buyers. Entertainment and tech layoffs have weakened demand at the top, while stricter short-term rental rules have undermined investor strategies. In areas exposed to wildfires, insurance alone can turn ownership into a liability. What makes Los Angeles particularly telling is how even ultra-luxury homes are affected. Properties priced far above the million-dollar threshold are seeing some of the largest nominal price cuts. When the most expensive homes struggle to attract buyers, it sends a signal throughout the market. Buyers sense leverage, and waiting becomes rational. Sellers who priced aggressively during peak years are forced to adjust or stagnate. The myth of endless demand begins to unravel. San Francisco illustrates the impact of economic concentration. Luxury housing there was built on tech wealth, venture capital liquidity, and relentless job growth. When those pillars weakened, the luxury market followed. Remote work emptied downtown towers, foreign buyers pulled back, and population decline compounded the slowdown. In high-rise luxury condos, the mismatch between supply and demand is particularly severe. Incentives replace appreciation, and prestige cannot compensate for falling values. Aspen and the Hamptons show that even elite retreat markets are not immune. These areas depend on concentrated wealth and seasonal demand. As financial conditions tighten, discretionary purchases are postponed. High carrying costs make holding second homes less attractive, especially when rental income softens. Sellers who once assumed scarcity would protect them are discovering that luxury only works when buyers feel confident about the future. What ties all these cities together is not collapse, but recalibration. Million-dollar homes are falling because the market is relearning how to price risk. Buyers are no longer willing to pay tomorrow's prices for today's uncertainty. Sellers are adjusting to a world where wealth preservation matters more than prestige. This shift favors patience, discipline, and realism. Understanding these cities is not about fear, it's about clarity. Luxury housing is not dead, but it is evolving. Prices are being tested, assumptions are being challenged, and confidence is being redefined. For buyers, this environment rewards preparation and restraint. For sellers, it demands flexibility. And for observers, it offers a rare opportunity to see how even the strongest markets respond when the rules change. As the countdown reaches its final cities, the pattern becomes unmistakable. New York City stands as the clearest example of how even the world's most famous luxury market can lose momentum when fundamentals shift. For decades, a million-dollar home in New York felt almost modest by local standards. Buyers accepted high prices because demand seemed endless, driven by global wealth, financial power, and cultural gravity. But today, that gravitational pull has weakened. Rising taxes, soaring maintenance fees, and softened demand have changed buyer behavior. Million-dollar apartments that once sold quietly now sit visibly on the market, marked by incremental price cuts and extended listing times. What makes New York different is scale. When luxury slows here, its effects ripple outward. International buyers have become more selective, Wall Street income is less predictable, and remote work has reduced the urgency of owning prime Manhattan real estate. Buyers are still interested, but they are no longer desperate. That shift alone can pressure prices because urgency was the hidden engine behind constant appreciation. Without it, the market behaves like any other. It negotiates. San Diego offers a quieter but equally instructive story. Long positioned as a safer alternative to Los Angeles, San Diego built its luxury appeal on quality of life. Ocean views, limited land, and a stable professional base supported high prices. But as costs rose, that stability began to fracture. Insurance tied to wildfire risk, high property taxes, and rising mortgage rates narrowed the buyer pool. Sellers who once relied on scarcity now find themselves competing. The result is not panic selling, but steady repricing. Million-dollar homes adjust downward as buyers push back against years of rapid appreciation. Las Vegas shows how quickly speculative luxury can reverse. Fueled by investors and second home buyers, the luxury segment expanded rapidly during the boom. High-end properties were marketed as lifestyle assets and income generators. But luxury markets built on optimism are vulnerable when returns fall short. As rental demand softened and financing costs rose, investors pulled away. Without them, inventory climbed. In Las Vegas, the fall of million-dollar homes reflects a return to fundamentals. Homes must justify their price, not just promise future growth. Across all 10 cities, the story is not identical, but the lesson is consistent. Million-dollar homes are falling where prices detached from sustainable demand. This does not mean luxury housing has lost its relevance. It means luxury has become conditional. Buyers expect value, flexibility, and financial logic, not just prestige. That expectation is reshaping negotiations city by city. For homeowners, this moment requires honesty. Markets no longer reward aggressive pricing automatically. Understanding local conditions, realistic valuation, and timing matters more than ever. Holding out for peak-era prices may result in missed opportunities. Buyers sense leverage, and hesitation favors those willing to wait. Sellers who adapt early preserve control. Those who resist may be forced into deeper concessions later. For buyers, the shift is equally significant. Falling prices do not signal danger by default, they signal choice. In many of these cities, buyers now have options that did not exist just a few years ago. Inspection contingencies return, negotiations reopen, terms improve, but discipline remains essential. The goal is not to chase declines, but to understand value. Buying into a city with long-term strengths at a corrected price can be advantageous, provided carrying costs and future risks are fully accounted for. Investors face a more complex equation. The era of effortless appreciation is ending, especially at the million-dollar level. Returns must come from careful selection, conservative leverage, and realistic income projections. Markets that depended heavily on short-term rentals are recalibrating fastest. Regulation, occupancy shifts, and rising costs demand a more measured approach. Luxury investing now favors patience over speed. The broader implication extends beyond these 10 cities. Luxury housing often acts as an early signal. When confidence weakens at the top, change usually follows elsewhere. Monitoring million-dollar markets offers insight into where the broader housing landscape may head next. Price corrections at the high end can stabilize markets by restoring balance. They can also expose fragility where overbuilding and speculation remain unresolved. What matters most is perspective. Million-dollar homes are not falling because they lack worth. They are falling because the market is relearning discipline. Prices are adjusting to reality, not collapsing into chaos. That distinction is critical. This transition rewards informed participants and punishes assumptions left unchallenged. As the housing market moves forward, the winners will not be those who react emotionally, but those who think strategically. Whether you are watching, buying, selling, or investing, understanding why these cities are shifting gives you an advantage. Luxury real estate is entering a more mature phase, one defined by scrutiny, balance, and intention. The dream of the million-dollar home is not dead, it is simply being redefined, and in that redefinition lies both risk and opportunity for anyone paying close attention.